Hi, this is Tax CPA Jim Trippon with TaxCPAHouston.com, and today we're going to be discussing pullbacks, corrections, and bear markets. Do you even know what these terms mean for you? Well, the COVID-19 coronavirus has put tremendous pressure on stock prices, causing some investors to blindly sell their investment in a panic state of mind, at a time that the entire financial market is trending lower. So worried investors believe, hey, this time it's different. When the market drops, some investors lose their perspective that downtrends and uptrends are just part of an investment cycle. When stock prices break lower, it's a good idea to review some of the common terms that you might hear on TV so you just understand them better. So first, let's look at pullbacks. A pullback represents the mildest form of a sell-off in the financial markets. If you hear an investor talk about a pullback, that's a dip of 5 to 10% from their most recent peak. The next term is correction. So that's a little more severe. A correction is when the market goes down at least 10%, but no more than 20% from the most recent peak. And at this point, you're probably on guard for the most severe one, and that's a bear market. A bear market is when the stock prices decline 20% or more since the last peak. Now, all of this is normal stuff. Pullbacks, corrections, and bear markets are all part of an investment cycle. When stock prices are trending lower, some investors second guess their risk tolerance, but periods of market volatility can be the worst time to make a change in your portfolio. Pullbacks and corrections are relatively common and represent something that an investor may see in their financial life from time to time, often several times in the course of just a single decade, whereas bear markets are much more rare. What we're experiencing now represents only the 9th bear market since 1926, and this bear market follows the largest bull market in American history. So how is a bear market going to affect you? Well, that's a good question, but that's something that you often won't fully understand and hear them now, because the average bear market lasts 146 days, for example, on the S&P 500. So what you really need is a retirement strategy that you built with the help of a financial professional that can factor in this volatility. And if you have that relationship with a financial professional, they'll be at your side to help you make the proper adjustments and decisions along the way. For more information about this or other topics, visit us on TaxCPAHouston.com.